Go ahead and start recording. Welcome everyone to the Elliott Wave Waiting Pool. My name is Garrett Patton. Many of you probably know me as Shift 4 on the website. This will be a bi-monthly webinar series with the goal of helping introduce new members to Elliott Wave principle. Hopefully I can familiarize people with the various patterns that make up the principle and the analysis methods used under the theory, particularly by Avi. Also some methods that can be used to trade the Elliott Wave principle, and finally, but most importantly, how to approach and begin doing Elliott Wave counts on your own in real-time markets. So the webinars will be broken up into 3 sections. First, I will spend some time at the beginning of each webinar going over the theory of Elliott Wave principle and some of what I find to be interesting nuances that are usually not taught in books or on other educational resources you might find online. Second, I will be going over wave patterns, their rules and their guidelines, as well as Avi's Fibonacci pinball methodology. And finally, I will have a section that I would like to call Adult Swim, where we will go over step by step an Elliott Wave count on a simulated real-time chart and how one might trade it. So we have 150 members in here tonight, 151 now, and I think we can get into the nitty-gritty stuff. But first I want to go over a little bit of the features on the website because I still see some questions from new members on how to use some of the features. This will be really quick, so anybody who is a seasoned member, please bear with me for a second. First, the question I see a lot is how to instant message somebody or private message somebody. In order to do so, on the top of the website, you will see the number of users currently in the room, in the trading room. If you click on it, a list of the users will come up. You can find the user want a private message, click message, type your message, and then send it, and you can communicate with them privately without your conversation showing up on the rest of the site. Second, if you were looking for a chart on a specific symbol, use the search function. And let's say I want to find charts on BAC. I recommend putting a space before and after the symbol, and that will bring up all posts related to BAC. If you want to see ones that are only related under stock waves that have been done by cow or have one of the symbols attached to them, go ahead and click on stock waves and we'll bring up a list of just those and filter out the rest of the posts. And finally, if you want to see a history of posts by somebody, say you're looking for one of the charts by Arkady, go ahead and type in Arkady's name, click on members under the filters. You'll find his name, and then you can pull up all of his posts in his past history, and you will find his charts under these posts. If you find that the charts are too small, given the box that pops up, I recommend right-clicking on it and going to Open Image in New Tab, and then you can get a full-screen version of the chart. So those are just a few of the features I wanted to go over before I actually started, since I find that people have questions about how to use the site a lot, especially new members. So back to the webinar. As I said, I want to go over the basic theory behind Elliott Wave principle. I'll be spending the beginning of all my webinars going over different aspects of the theory. For this first one, I want to focus on the biology and science that is kind of the basis for Elliott Wave principle. First, we have the idea that the brain is divided into primal, emotional, and rational. Now, Paul MacLean developed the concept of a triune brain, which suggested that our brain is divided into 3 basic parts: the basal ganglia, the limbic system, and the neocortex. So this is the division of the brain into the primal, emotional, and rational. The evolutionary progression of our brain developed these 3 sections stacked upon each other. This can be evidenced by reptilian brains that share our basal ganglia and mammalian brains that share our limbic system. As evolution ran its course, resulting species of increased cognitive capacity, their brains developed outwardly, adding new layers of complex mentation and eventually leading to the development of the neocortex in certain primates. And since evolution proceeds from forms already available, which is why, sorry about that. Since evolution proceeds from forms already available, this is why we retain the most basic brain structures of our animal ancestors, and where this idea that we still have emotional our brain is still subject to primitive and pre-rational impulses. So basically the point of all of this is that the human mind is, like I just said, still subject to primitive and pre-rational impulses despite our highly developed neocortex. In contrast to the neocortex, which processes ideas and other information using reason and analytics, the basal ganglia and limbic system operate in a much more instinctual, impulsive, and rigid manner. These areas of the brain are integral to functions of survival, breeding, motivation, etc., and underlie the subjective experience of emotional feelings. Studies have shown that this portion of the brain does not make value judgments and instead controls impulsive and not reasoned behavior. One of these studies found that rats would forego food and sleep to receive an electrical current that would stimulate the pleasure center of their brain, which is found in the limbic system. Basically, there was a lever that the rats would pull, which would send a current into their brain, which would stimulate the hypothalamus, which produces dopamine, which is one of the neurotransmitters that sends pleasure to our brain. Now, these rats would continue this behavior until they eventually died, showing that there is really no satiation point for this kind of stimulation. So this shows how powerful the objectives of our limbic system can be over rational thinking. Other research has found that emotion and corresponding reaction can occur both independently of and prior to thought. The amygdala, which controls our flight or fight response to threats, is only one synapse away from synapse away from the thalamus, allowing us to skip processing from the neocortex altogether. So certain emotional reactions occur before the brain has even had time to fully register what it is that is causing the reaction. So in a sense, emotion can occur before thought. The next idea is that we are hardwired for certain emotional and physical patterns of reaction. So how is this relevant to Elliott wave principle? The limbic system, the emotional center of our brain, is faster than the neocortex, which I just evidenced by the amygdala and its ability to bypass the neocortex to reach the hypothalamus. It regulates the amplitude of emotions, allowing it to drown out processes of the neocortex and reason, and it is dissociated from the concept of time, disarming the neocortex of planning in terms of achieving long-range goals. What it wants immediately. Finally, the limbic system has proved essential for a sense of personal identity and reality. People who have lost portions of that area lose the crucially important feelings attached to both their identity and that of their environment. The limbic system has the capacity to generate out-of-context feelings of conviction that we attach to our beliefs regardless of whether or not they are true or false. One proof of the powerful emotions associated with our limbic system is found in epileptics. They experience storms of emotion that have nothing to do with the reality at that moment. It's basically just their limbic system firing in a frenzy. Epileptics also experience feelings of immense conviction about an absolute truth that is not connected to any associated idea or thing whatsoever. This occurs in normal people as well, who can experience feelings of certainty so overwhelming that they stand fast in the face of any logic or contradiction. So basically, this tendency is so powerful, in fact, that most people are said to live in their limbic system. And this is particularly in respects to ideas or knowledge that lack expertise. So now we get into how this affects financial markets. Basically, the point of all of this is that as a primitive tool of survival, the limbic system impels individuals to seek signals from others in matters of knowledge and behavior. The desire to belong to and be accepted by the group is so powerful it can overwhelm the higher brain functions. In instances where reality or knowledge is lacking or irrelevant, this conviction to align with the group becomes even more powerful. For example, financial markets, where so few are knowledgeable, and fashion, where logic is really irrelevant. Now, there have been numerous studies to support this as well, and it shows that individuals routinely correct their own errors when alone, but abdicate their responsibility when acting in a group with strong social agreement. So a study was done at the University of Arizona, conducted of 60 laboratory market simulations, using volunteers composed of economic majors and businessmen. All the participants were given the exact same perfect knowledge of coming dividend prospects of companies and then their actual declared dividend at the end of the simulated trading day. The subjects routinely created boom and bust market profiles despite possessing true knowledge of coming events that are of so-called fundamental value. So this just goes to show you that human emotions are rhythmical. Now, Elliott described this phenomenon as an error of optimism that tends to create throughout the community a certain measure of psychological interdependence until it leads to a crisis, either the boom or the bust. Then the error of optimism dies and gives birth to an error of pessimism. So this is kind of the cycles or business cycles or market cycles that I'm sure you all have heard of. In financial markets, when price is soaring or crashing, the limbic system senses an opportunity or a threat and impels you to join the herd in an effort to increase your chances of survival. Now, this reaction is very useful in a number of different social situations, but it really is not useful at all in trading. This is where you get in trouble and are left holding the bag, as so to say. Now, when the unconscious mind operates, it could hardly do so randomly, as this would mean there is no thought at all. So instead, it operates in patterns that are peculiar to it. And this is kind of the basics of Elliott wave principle, these patterns that the unconscious mind operates in. So regardless of divergent thoughts and actions of any individual, the crowd will follow its characteristic patterns of behavior. Now, I hope that you guys found that somewhat educational and it wasn't too dry. It's stuff that really interested me and I thought was useful when trying to understand Elliott wave principle, and I think is useful even when you apply it to your approach in trading, because it helps you understand how irrational the market can be and allows you to dissociate yourself from rational thinking that, you know, according to all these fundamentals, the market should crash and go down right now. Whereas if you just follow what price tells you and the wave patterns, you'll be a much better trader because of it. So that brings me to the basics of Elliott wave principle. At its most basic, the wave principle is a method of market analysis based on crowd psychology and pattern recognition. Now, I already went over some of this crowd psychology, and I'll go through the pattern recognition and patterns that are associated with Elliott wave principle in a second. In the 1930s, Ralph Nelson Elliott discovered that stock market prices trend in reverse in recognizable patterns. The patterns he discerned are repetitive in form, but not necessarily in time and amplitude. So these patterns link together to form larger versions of themselves, to form the same patterns of the next larger size, and so on, producing a structured progression. So Elliott believed that the upward and downward swings of mass psychology always showed up in the same repetitive patterns. A pioneer behind the idea of fractals was Benoit Mandelbrot, and he was an IBM researcher. His discovery dispelled the idea of randomness in natural forms. So it had previously been presumed that there was no single geometry that governed clouds, seacoasts, mountain ranges, trees, etc. And I think most of us would agree that that belief still is held true about social phenomena such as popular trends and stock prices. People think that there's no single geometry to price action and that it is completely random. But the wave principle is the first idea to challenge this. So Elliott was first to describe this self-affinity as a fundamental property of social phenomena and to recognize its implications for social causality. So he found that these patterns repeat across time and scale in a fractal nature. Basically, there's regularity in the underlying fluctuation of financial markets. Price movements in stocks are subject to rhythms and an ordered sequence. Current news and political developments are of only incidental importance, and their presumed influence on market trends is not as weighty as commonly believed. I'm sure you're all familiar with Abby's stance on this and how he views fundamental analysis and news. There's a great quote by Elliott which states that at best news is a tardy recognition of forces that have already been at work for some time, and it is startling only to those unaware of the trend. So underlying all this progression in whatever field, be it market prices, social trends, politics, economics, whatever, is a fixed and controlling principle and fluctuation, a master rule by which nature works. So like so many other phenomena in nature, Elliott also discovered that the progress of price swings in financial markets have a mathematical base related to Fibonacci sequence. If anybody is unfamiliar with the Fibonacci sequence, the idea is that it's a sequence of integers where the subsequent number is the sum of the previous two. So if you have the numbers 0 and 1, you add them together, you get 1. You take the previous integer, 1, add it to 1, and you get 2. 1 plus 2 is 3. 3 plus 5 is 8. 8 plus 5 is 13. 8 plus 13 is 21. 13 plus 21 is 34, and so on and so forth. Now the limit ratio between these is the golden ratio, or 0.618. This is found by taking one of the integers and dividing it by the following integer. And as you go farther out in the list, the closer you'll get to this golden ratio, or 0.618. I'm sure you're all familiar with this decimal. We use it all the time in our analysis of Elliott waves. Phi and the Fibonacci sequence are of paramount importance in nature in processes of growth and decay, progression and regression, etc. From things as small as the as small as DNA to things as large as spiral galaxies. The proportions of the human body, from our head to our torso to our arms to our legs, all follow expressions of phi, or 0.618. The most basic aspect of this relationship between the Fibonacci sequence and the Elliott wave principle is that the subdivisions of Elliott waves reproduce the Fibonacci sequence. So if you start with the most basic market movement, which is a straight line up, and then in a bull market, in a straight line down in a bear market, you add those two together and you get 2. 1 plus 1 is 2. Then you take the next fluctuation of price at its most basic form, which is 3. Which would be 1 move down followed by an interruption, and then 1 further move down. 1 plus 2 is 3. If you go to the next, if you go one level up of complex wave structure, you get 5 waves. 1 wave up followed by an interruption, followed by another wave up, an interruption, and 1 more wave up. So as you can see, as you go more and more complex in these wave structures, they actually follow the Fibonacci sequence. However, more importantly is that these waves progress and scale according to various expressions of phi. So this is where we use Fibonacci ratios in order to find price targets when we're doing our wave analysis. So Elliott identified 5 distinct patterns that price action of any market could be broken into. And these patterns are divided into either impulsive, which means that they're moving in the direction of the larger trend, or corrective, which means they are moving against the larger trend. So these patterns are broken into these 2 categories. Now before I get into these patterns, I wanted to go over actually trading Elliott wave principle. Now, I think there's a very prescient quote in the Frost and Prechter book, and that quote is that the primary value of the wave principle is that it provides a context for market analysis. Many people think that the Elliott wave principle in and of itself is a trading methodology, but it's not. Basically, it's a way of going back and analyzing the market. It doesn't necessarily give you the rules to trade. So we have to apply our own trading methodology to the Elliott wave principle analysis. And here are some of the things that Elliott wave principle can help you with when you're trying to use it to trade. First, the wave principle helps identify the larger trends. Now I'll go over the basic structure or the basic pattern of Elliott wave principle on the next slide, but by using these patterns we can identify which moves of price are that go with the larger trend and which moves are going against the larger trend. So as I just said, it helps identify counter-trend moves within that larger trend, ones that you probably want to avoid trading or use as an entry to go with the trend when you are trading. It can help identify the resumption of the larger trend after the completion of a correction. So you can actually figure out when a correction is likely going to complete and then look for an entry as a trade to go with the larger trend. Next, it can be used to identify the termination of a trend. So you can know ahead of time when a good idea to maybe take profits or to tighten your stop loss or to maybe take off a partial position that you might have going. And it can also provide high probability targets. Using the Fibonacci analysis associated with these patterns, you can identify where price is likely going to head next. And this is really important when you are putting together a trading system or a trading strategy. You always want to know what your target is when you initiate a trade. Probably more important than that is it provides specific rules of invalidation. So this is basically where you set your stop loss and tells you when your trade is not going as you expected. It'll tell you that your analysis was wrong and that the market is not going to do what you expected and your target is likely not going to be hit. So this is really important because it helps you place a stop loss and helps you get out of a trade when it starts turning against you. Now, what's very important, I think, is that trading and analysis are completely two different disciplines. This is really important to understand. You must first identify what type of trader you are before you can apply Elliott wave principle to your methodology. So like I was saying, the principle in and of itself is not a trading plan. It's not a trading strategy. You have to figure out your own strategy that you're going to then apply to the Elliott wave principle. There are a number of different ways to trade it, and there are a number of different ways to enter a trade, exit a trade, and manage a trade using the wave principle. So you have to first identify whether you are a day trader, somebody who's going to stay in a trade for minutes to, say a few hours. If you're a swing trader, if you plan to hold positions for a couple of days to maybe a week, or if you're a more long-term oriented trader and you're planning on holding your trades for weeks to months to even years. So now we're going to go over the basic pattern of the Elliott wave principle. Now, in its most basic form, the Elliott wave principle is composed of a 5-wave structure followed by a 3-wave corrective move. Now this pattern reflects the two basic modes of wave development. Impulsive, which is the 5-wave pattern. It's also known as motive if you look in the Frost and Prechter book, and corrective, which is the 3-wave pattern. Now it's paramount to understand the difference between these two roles in both their in how they work in the wave principle and their construction. So an impulsive or a motive wave has a 5-wave structure. It's labeled using numbers, so if you're ever looking at one of Abby's charts, any chart that is numbered using either Roman numerals or regular numbers is an impulsive wave. A corrective wave has a 3-wave structure and it is labeled using letters. So it can be ABC or it can be XYZ, as I'll show in some of the other patterns later. Now these corrective patterns serve to correct or partially retrace the progress achieved by the preceding impulsive wave. Now this process is fractal in nature and it repeats on different levels of degree. Now this is not to be confused with scale since the waves can vary in size, but it takes a certain number of them to create the next wave of higher degree. So an impulsive wave is always moving within the trend of one higher degree. Now this is true of even corrective waves. Because an impulsive wave will be in a C wave position, but if you move 1 degree higher, you will notice that the trend of that degree is still down, or corrective. So going along this fractal nature, these impulsive waves that are moving within the larger trend of this larger impulsive wave are also composed of 5-wave structures. Now I'll go into this in more detail in a second. And if you go 1 degree higher, as you can see, we have a wave 1 and 2. If we were to go 1 degree higher and continue this price action, you would see that it looks something like this. We have an initial move up followed by a correction. So this whole pattern is fractal in nature, and each degree should be identifiable in its relationship to the higher and lower wave degrees. But regardless of the degree, the form is constant. Impulsive waves do not always point up, and corrective waves do not always point down. If the trend is down, an impulsive wave will be facing down in a bear market, and it will be facing up in a bull market. An impulsive wave is always trending in the same direction as a wave of 1 higher degree. As I said, that is very important. This is how on the previous slide, it helps you identify the larger trend. When you look for an impulsive wave, you know that it is moving, at least that one impulsive wave is moving in the direction of one higher degree trend. Now some people might ask, why 5 and 3? Basically, this is the minimum requirement for achieving both fluctuation and progress in linear movement. One wave does not allow fluctuation. The fewest subdivisions to create fluctuation is 3 waves. However, 3 waves moving up followed by 3 waves moving down does not allow for progress. To progress in one direction, despite of periods of regress, movements in that direction must be at least 5 waves, simply to cover more ground than the intervening 3 waves. While there could be more waves than that, the most efficient form of punctuated progress is 5 waves up, 3 waves down, and nature typically follows the most efficient path. So now we're going to go over the actual patterns that make up the Elliott wave principle. First, we're going to start with the standard impulse wave. The basic model of the Elliott wave principle is simple, but in reality, it's a little more complex than that. Hold on, I have a question right here. I'm confused on the concept of an impulsive wave operating on one higher degree. So basically, whenever you see an impulsive wave, which is just another way of saying 5 waves, it's always going to be moving in the direction of one higher degree. Now, you might be confused because you think corrections are not within the direction of the trend. However, a 5 wave move can never be a correction in and of itself. It's always going to be part of a larger 3 wave move or more complex correction. So if you find a 5 wave move, it's always going to be in the direction of one higher degree. So even if it's part of a correction, that correction is going to be 3 waves, and this 5 wave move is only 1 wave. A 3 wave move cannot be impulsive, because impulsive basically means 5 wave structure. Now you can have impulsive waves within a correction, and they are always found in the C wave or the A wave. I'll go over the specifics of the patterns in more detail in a second. By one higher degree, I mean the fractal nature of a market. So if you were to break up this first wave in this 5 wave structure, you would find that it is divided into 5 waves as well. I have an actual example here of a real price chart, and hopefully you can see what I mean by this. So if we were to look at this 3rd wave here, you'll notice that it is also broken up into 5 waves. So this 3rd wave, the 5 wave structure in here, is 1 degree less than this larger 5 wave structure. Does that make sense? And if you look, you can break it up even further. As I said, it's completely fractal in nature. These patterns repeat on top of each other in order to create price movements in markets. So if we look at the 3rd wave within this larger 3rd wave, we can also see that it is broken up into 5 wave structure. So this is what I mean by different degrees. When you are trading, or at least communicating to other people on those sites, always try to understand what wave degree you're talking about. When you are labeling it on a chart, you usually, I personally use different colors. I try to use different size font and Roman numerals as opposed to integers when trying to differentiate the degrees of my wave counts. Sorry, I forgot something on this slide. So there's a few rules that I want to go over about the standard impulse, and they're pretty simple. Basically, wave 2, this corrective wave, can never retrace more than 100% of wave 1. So this end of wave 2 can never go below the start of wave 1. This is simply because an impulsive or motive wave is supposed to be creating progress, and retracing more than the initial move does not create progress. So if that happens, you have a corrective wave, and it is not an impulsive wave you are looking at. Next, wave 3 can never be the shortest wave. Now this is just a standard rule that you should always watch for, and if you come across an instance where the third wave might not be the longest wave, go ahead and measure them and make sure, because if it's not, then you are not looking at a standard impulsive wave. It has to be the longest, or it has to be, it cannot be the shortest wave. That doesn't necessarily mean it has to be the longest wave, but it cannot be the shortest. And finally, wave 4 cannot enter into wave 1 territory. There's an exception to this in what's called a diagonal, but for a standard impulse wave, this rule must be held true. In order to create progress, the waves cannot be overlapping, so this fourth wave cannot enter into wave 1 price territory. If it does, you're either looking at a diagonal or some sort of other corrective move. Basically, this, again, just ensures that the impulsive wave is making progress in a certain direction. Impulsive waves are strongly trending moves. They delineate the larger trend. And these are basic rules that you should follow in order to help label these 5-wave moves and identify them on a price chart. There are some tendencies as well of an impulsive wave, and that is that the third wave is usually the longest, this wave right here, and that the two corrective waves, wave 2 and 4, alternate in form. So I'll go over some of the corrective forms in a second, but you'll often find that the second wave and the fourth wave do not have the same corrective pattern. This is just something to help you trade and recognize patterns in a real-time chart as it's happening. It's a lot easier to go back and recognize wave patterns, but to recognize them as they're progressing is a lot more difficult. So I'm going to look at some of the questions here. My wave 3 is shortest. I'm not sure. I'm not sure where you're talking about on that. I'll go over identifying an actual impulsive wave structure later on in the webinar. All right. So the next form of pattern that we're going to look at is the ending diagonal. Now this is also considered an impulsive wave. However, it breaks some of the standard rules that I just went over. And the main rule that it breaks is that the fourth wave is allowed to enter into the wave 1 territory. Now, ending diagonals occur in fifth wave positions or in C wave positions. Let me bring up the questions again. Okay. Now, Elliott described them as occurring when a preceding move has gone too far, too fast. In all cases, they are found at the termination points of larger patterns. Now, this means a fifth wave, so it's at the end of a 5-wave impulse, or a C wave, which is at the end of a 3-wave correction. So whenever you see an ending diagonal, it means that the trend is about to change. And these are great patterns to help identify because they allow us to know when the trend is about to change and hopefully either get out of position or appropriately position ourselves for a trend change and, maybe go short if we were going long and look for the next wave move down. In this case, if we're looking at a bullish market where the ending diagonal is trending up. These patterns indicate exhaustion of the larger movement, and their subdivisions are always 3 waves. Unlike a standard impulse wave, which the subdivisions are broken up into 5-wave structures, the subwaves of an ending diagonal are always 3 waves. Always. There are 2 varieties of ending diagonals. One is the contracting variety, which you see here, where the boundary lines, these trend lines, converge towards a point. But there is also an expanding variety, but it is incredibly rare, and you usually will never ever see it. But they do happen. I've seen them before, so watch out for them. But I'd say probably 80 to 90% of the time, the ending diagonal is going to be of contracting variety. Either that or the trend lines are going to be parallel to each other. This pattern is also, some of you might be familiar with it as a rising wedge in traditional technical analysis. There are some rules for an unending diagonal as well. The third wave in an ending diagonal cannot be the shortest wave. As you can see in this instance, wave 1 is longer. However, wave 5 is shorter than wave 3. So as long as the third wave is not the shortest wave, you're okay. Another rule, same as the standard impulse wave, is that the second wave cannot retrace below the start of wave 1. Now, I've seen a few people label diagonals where this does happen, and that's simply incorrect. You cannot label it that way. If that happens, then you're looking at another pattern that's connected to this diagonal that you need to count differently. So wave 2 cannot retrace past the start of wave 1. There are some other tendencies of an ending diagonal or guidelines that you can use while trading. If the wave 4 happens to come past this trend line slightly, it's what Elliott called underthrow. It means that the fifth wave will likely exceed this trend line on top. So if you see underthrow, it comes past this trend line. On the fourth wave, you will likely see overthrow on the fifth wave, which means it will exceed this top trend line. Now the fifth wave can fall short of the trend line, can truncate slightly, but it tends to usually hit the trend line or exceed it slightly in most cases. Most importantly, I forgot to bring up an actual price chart that shows an ending diagonal, but most importantly from an ending diagonal is that the retracement, the move after it, when the price trend changes, it's usually followed by a very sharp decline that retraces at least back to the level where the ending diagonal started, and typically much further. So these can be great patterns to recognize ahead of time because they create sharp and violent moves out of them. Somebody just asked, are real diagonals pretty rare? If you've been following some of our analysis recently and the price action that the markets have provided us, you will notice that we have seen diagonals constantly lately. They are all over the place. Ending diagonals are actually not very uncommon. They're pretty common in markets, even in strongly trending markets. But leading diagonals are not as common. However, like I said, we've seen them a bunch lately, and it's almost something that you have to expect at this point. So here's an actual price chart of an ending diagonal. You can see that the subwave structures are made up of three waves. We have three-wave move in our first wave, three-wave move in our second wave, three-wave move in our third wave, our fourth wave, as well as our fifth wave. So next we're going to focus on leading diagonals. It's pretty much the same structure. I drew this one as if it was in a bearish market just to show that these patterns can be either trending up or down depending on whether you're in a bull or a bear market. Here's an actual price chart of one. Leading diagonals can appear in the first wave position of an impulse and in the A wave position of zigzags. Typically the subdivisions, just like ending diagonals, tend to be three. So you can see three waves here, three waves, so all three wave structures. However, there is a rare variety where these impulsive waves, the waves 1, 3, and 5 of a leading diagonal can be five-wave structures. But again, this is pretty rare. Whenever you're looking for a leading diagonal, you're typically looking for a three-wave structure. A leading diagonal differs from an ending diagonal because the ending diagonal is always at the termination of a move. That means it's either in the fifth wave position of an impulse wave or the C wave position of a corrective move. A leading diagonal signals the start of a new trend. So a leading diagonal is going to be in the first wave position of a larger impulse or the A wave position of a corrective zigzag. And that's the three-wave structure that we see in the corrective moves. A leading diagonal follows the same rules as the ending diagonal. The wave 2 cannot retrace past the beginning of wave 1. Wave 3 cannot be the shortest wave. And it follows the same tendencies too, so you can have underthrow and overthrow on the 4th and 5th wave. And after completion of the leading diagonal, the retracement out of it usually tends to be very sharp and very violent. You can kind of see that on this chart when once we hit the bottom, we saw a nice violent move out, which is nice to trade. So we have a question, how can the first wave of an impulse be opposite the direction of a new trend? We'll go over how these different price patterns connect with each other when I do the Adult Swim portion of the webinar, or I go over counting an actual price chart. But basically, you can have these in an A-wave position. So if we had a 5-wave move up preceding this, and then had this impulse wave down, we'd know that we are starting a corrective move. Again, an impulsive 5-wave structure move is always going to be in the direction of one larger trend. So a leading diagonal, an ending diagonal, a standard impulse can never be a corrective move in and of themselves. They will always be part of a larger corrective move. Leading diagonal, yes, can also be expanding. However, again, it's more rare than the contracting variety. So you'll either see these trend lines converging on a point, or they will be parallel to each other. I think the expanding variety is a little more common with leading diagonals than ending diagonals, but again, usually you're going to see this contracting variety. All right, so I just covered the impulsive wave structures, ones that go with the larger trend, and now we're going to focus on corrective wave structures. Those are the 3-wave moves that we saw in the basic Elliott wave pattern earlier on. Hold on, I'm getting a few more questions. Can a leading diagonal be a wave 1 of an impulse? Yes. A leading diagonal can be a wave 1 of an impulse or an A wave of a zigzag pattern. So it would be this 5-wave move right here. So again, a leading diagonal is the start of a new trend. This trend doesn't necessarily have to be this doesn't have to be like a trend that's going to last forever, but it's going to be the start of a new trend of one larger degree. So in a corrective case, the A wave, if you have a leading diagonal, would be part of a 3-wave move that's correcting a larger trend moving up, if that makes sense. Leading diagonals, do they usually end with a big breakout as ending diagonals end with a big breakdown? Yes, they follow the same tendencies. So after a leading diagonal, you will have a very sharp retrace. Now if this is part of a 5-wave impulsive move, so it's in the 1st-wave position, this sharp retrace will not exceed the beginning of the diagonal, since we know that in a 5-wave impulse, the wave 2 cannot retrace past the beginning. Let me go back to that to illustrate that point. So if we have a leading diagonal in this position, the retrace from it will usually be sharp and violent, and it'll retrace the majority of the diagonal. However, it cannot exceed the start of wave 1, or else you're not looking at the standard impulse, and it's not a wave 1 of a larger 5-wave move. However, you'll typically see it hit at least the 0.618 or 0.764 retracement. Yes, if it retraces past that initial move, past the beginning of the diagonal, then you are likely looking at a B wave, an expanded B wave of a corrective move. So again, these are the impulsive moves, and now we're going to start looking at corrective moves, starting with the zigzag. The zigzag is the most simple and common corrective pattern, and it's labeled ABC. The subwave sequence of a zigzag is 5 waves, followed by a 3-wave correction, followed by 5 more waves down as a C wave. Again, these are labeled A, B, C, as all corrective moves are labeled by letters rather than numbers. Now, some of the tendencies of a zigzag are that the B wave tends to retrace about 50% of the A wave, and it never exceeds the beginning of the A wave. So in this case, you can see it exceeded a little more than 50% in this actual price chart, but it cannot, in a zigzag, exceed the start of the A wave. So this would be the start of the A wave, the end of the A wave, the start of the B wave, end of the B wave, start of the C wave, end of the C wave. And the subwaves of this structure are 5, 3, 5. So on this actual chart pattern, we can see 5 waves down, followed by a 3-wave retrace, and then 5 waves in the C wave. Next, we're going to look at flats. In this example, I picked an expanded flat. But if you are expecting a correction and you only get a 3-wave move down, it is considered a flat. Now, that doesn't necessarily mean that the B wave is going to retrace past the beginning of an A wave, and it can still carry out generally the same structure as a zigzag. However, it's just the typical way you identify what this structure, wave structure, corrective pattern is. It's called a flat. This variety is called an expanded flat because the B wave retraces above the start of the A wave. Flat corrections, like I said, differ from zigzags in that the subwave sequence is 3 waves down in the A wave, 3 waves back up in the B wave, and then 5 waves down in the C wave. The B wave tends to retrace close to, around the start of the A wave, or exceeds it in the case of this expanded flat. Pull up an actual price chart. A flat correction usually retraces less of the preceding impulse wave than does a zigzag. It tends to occur when the larger trend is strong, so it virtually always precedes or follows an extension in an impulse wave. So if you have a very strongly trending third wave up in an impulse wave, it's very common to see a expanded flat in the fourth wave position. Now you can see that the price is still trending strongly in the direction of the larger trend when the B wave moves up past the start of the A wave. However, you must be careful when you are identifying these patterns because many might consider this the top of a price swing because that's where the actual high was made. However, this is what we call an unorthodox top. If you look carefully at the price structure, you'll notice that it is in 3 waves. So this cannot be an impulsive wave and therefore cannot be part of one larger degree trend. So when you identify these tops that are unorthodox, look for the 3-wave pattern, look for a strongly trending move before it, and you'll notice that you have an expanded flat. So like I said, they're most common in the 4th wave position. And the C wave tends to end substantially beyond the ending level of A. If you're looking at Fibonacci relationships, an expanded flat tends to have a 1.618 relationship of the C wave to the A wave. So if you take the measurement of this move, you will notice that this move is 1.618 times the size of this move. Now this is very common for expanded flats for the C wave to go beyond the A wave substantially. There are 2 other varieties of flat corrections, and that is a regular flat, where the C wave tends to not necessarily extend past the end of the A wave very much, and the B wave does not exceed the beginning of the A wave, as well as the running flat. Now the running flat happens when the C wave does not extend past the end of the A wave. So let's say the C wave ended here and we had 5 waves down to this point right here. That would be considered a running flat. Now these are very rare, however they do happen in extremely strong trending markets. But again, they're rare, so don't go ahead and just label it like that, to start with, assuming that you have a running flat and we're already in the next wave up. I'm looking at questions here. I'll go over drawing the fibs in a second. How would I recognize an impulsive move versus a corrective move. Yes, corrective moves are 3 total waves, while impulsive moves are always 5 waves. So if you have a 3-wave move, it cannot be an impulsive wave in and of itself. So from here to here, this is not considered impulsive because you can see that it's made up of 3 waves. Within that corrective move, you can have impulsive waves, such as the C wave, where you can see here this is a 5-wave move. But corrective moves are always 3 waves, and impulsive moves are always 5 waves. On a regular flat, what is the characteristics of the C wave again? On a regular flat, the C wave will tend to slightly exceed the end of the A wave. So if the B wave doesn't retrace past the beginning of the A wave, then you'll usually have a 1-to-1 relationship between the A wave and the C wave. On the site, we say this is A equals C. It reaches the 1.0 extension. Basically, it doesn't move quite as far past the end of the A wave as an expanded flat does. Next, we're going to look at a little bit more complex pattern, and that's a double zigzag. Now, a double zigzag is when your C wave does not have 5 waves. A C wave must always have 5 waves. If you were originally looking at this as a possible zigzag, you had, or I should say it's a flat because this was only a 3-wave move. But you were expecting a 5-wave move down in the C wave, and you did not get one. You only get a 3-wave move. Then it's what's called a double zigzag. And this happens when you have 2 zigzags that are connected together. So if you go back and remember when we were talking about zigzags, we have a 5-wave move, 3-wave correction, and followed by a 5-wave move to make up a 3-wave correction. You have 2 of these connected together by what's called an X wave. And this is another 3-wave corrective move. This tends to happen if the initial 3-wave move didn't, reach the standard retracement levels, if it didn't seem like it corrected enough of the preceding move, if it didn't seem like it filled out enough time, you'll tend to get these double zigzags or complex corrective moves. I'll go over a little bit more complex corrective patterns in the next webinar, but you can have 3 of these in a row. They don't necessarily have to be zigzags. They can be flats, expanded flats. Basically, you can have a bunch of different corrective moves connected together to make a larger corrective move. And you will see that there's still 3-wave structures within them, though. That X wave in real-life example looks like a 5-wave. How do you define a wave? Are you talking about this wave right here? If you'll notice, it's in a 3-wave move. So this is not an impulse. You know that the next trend has not started, the next move, up in this case, because this is moving down, has not started because this only happens in 3 waves. If you look at how I labeled it here, you have an ABC followed by another ABC. This is an expanded flat because the B wave moved beyond the start of the C wave. And you'll notice that this X wave is in 3 waves, not 5 waves. So an X wave is still part of a correction because it's not an impulsive wave. It still has a 3-wave structure. Next, we're going to look at a triangle. A triangle pattern contains 5 overlapping waves that subdivide into 3, 3, 3. And they're labeled A, B, C, D, E. A triangle appears to reflect a balance of forces, basically causing a sideways movement that is usually associated with decreasing volume and volatility. So in a standard triangle, you'll notice that the volume starts decreasing as you start reaching the end of it. You can't really see it on this price chart, but the technicals will start flattening out. And basically, the market is coiling for a large move in one direction. Now, when triangles happen, they usually indicate the end of a move. they happen one position prior to the final actionary wave in a pattern of one larger degree. So you'll find them in fourth wave positions or B wave positions, which means that there's only one more wave to follow the triangle in the trend of one larger degree. So if you're looking at a fourth wave position and you see or if you're looking at an impulsive wave and you see a triangle in the fourth wave position, you know the fifth wave is about to start, and that is going to be the end of that trend of one larger degree. There are four varieties of triangles: contracting, barrier, expanding, and running. As you can see right here, this is a contracting variety. A barrier variety is when one of the trend lines is flat. So you have the A, C, E waves all along a flat horizontal line, or the B and D waves all along a flat or horizontal line. You can have an expanding triangle where the A wave would be the shortest, then you get a slightly larger B wave, a slightly larger C wave, a slightly larger C wave, where each move is kind of preceding two waves before it, the high by a slight amount, and same with the E wave. I don't know if you guys remember the chart that Abby put out today of ES, but we were looking at a possible expanding triangle where each one of these waves, the ending of these waves was making a slightly higher high or slightly lower low, with the exception of the E wave, which possibly truncated. I was looking through my charts and I couldn't find one with the time I had, so please apologize. I'll look for one for the next webinar. But if you can see here, this is a contracting variety. And hold on, I'm going to look at some questions. So somebody asked, triangles look like ending or leading diagonals. They do, but you'll notice that triangles are not making progression in any real direction. They are a sideways consolidation. So you can never have a ending. Okay, let me go back to the diagonals to make this clear. Probably should have said this. For an ending diagonal, the wave 3 must always exceed the end of wave 1, and wave 5 must always exceed the end of wave 3. Like I said, wave 2 cannot exceed the beginning of wave 1, and wave 4 cannot exceed the beginning of wave 2. So you can see they are moving in a direction, and they are making progress in a direction. So let's go back to triangles. There is a variety of triangle, which is called a running triangle, where it does make progression in a direction. As somebody pointed out, Apple has a possible fourth wave triangle that is moving in a direction. I suppose it might be difficult to distinguish a running triangle from an ending or leading diagonal. However, you just must look at the wave structure of one larger degree to see if there should be an ending diagonal in that position, or if this is more likely a fourth wave or a B wave, in which case you would be looking for a triangle. But again, these triangles usually indicate they are near the end of a move. So the following wave out of a triangle is going to end the trend of one larger degree. Let's see here. So usually the triangles are composed of three waves. However, the subwaves can be more complex in structure. They don't necessarily have to be three waves, but they're never five-wave moves, impulse moves. They can be the flats that I was showing you. You can even have a triangle within a triangle. This usually happens in the E wave, where it just continues expanding in a triangle form as it gets closer and closer to the converging point. And one thing to know about triangles is that it's very easy to label them and identify them as complete too early. So this is a mistake that a lot of analysts make. I'm sure I make it sometimes too, but sometimes when you think that a triangle is complete, it's not complete yet. You might only be in the C wave completing or the D wave. So please pay attention to this and recognize that if the following move that you thought after the completion of the triangle is not impulsive, that you might and probably are still within that triangle. Basically, they move sideways to work off overbought internals, and they do it through time rather than really retracing a lot. Looking at some questions, can you identify diagonals, triangles, zigzags as they are forming? I mean, this is, once you identify all these patterns, it's hard to kind of apply them to a price chart. However, the next section of the webinar, I'm going to be going over counting in real time, and hopefully we can address some of those issues and how we can identify patterns as they happen. When a triangle completes, how do you know which direction it will break? You know which direction the triangle will break by looking at the previous wave. So triangles always precede the last wave of that previous trend. So if the move up into a triangle was an impulsive 5-wave move, let's say a 3rd wave, and this is a 4th wave triangle, you know that the next wave will break up out of the triangle. The same goes for a, let's say, a zigzag corrective pattern. If we had an A wave that led into this triangle, then when we know that the C wave would break up and out of the triangle, because there is one exception where that can be the end of a pattern, but we'll go over that in a later webinar. It's a more complex pattern, but just for now, know that they always precede the end of a move, and there's going to be one last wave out of them. So just look, if you're looking for which way a triangle is going to break, just look for whatever direction that previous wave coming into the triangle was moving. In an expanded triangle, does the E wave necessarily need to make a new low or high retrace more than the C wave? No, the E wave can truncate. You'll notice that the other waves usually are going to hit or come very, very close to the bounds, but the E wave, the final wave, can truncate and doesn't necessarily have to come down back to this bound. It's also very common for the E wave to exceed this bound very slightly. However, the triangle should be technically considered invalidated if that E wave exceeds the C wave in the contracting variety, since the progressing tops have to get tighter and tighter within a range. F&P page 90 states contracting triangles always subdivide into 5 waves. You might be looking at a leading diagonal. The subwave structure of triangles is never impulsive. They'll never be 5-wave moves. If it looks like a 5-wave move, it's likely a complex correction of connecting 3-wave moves. Oh, okay, yes, you're right. Sorry, I was confused by that question. By 5 waves, it means that it subdivides into this A, B, C, D, E. I was thinking you were talking about the subwave internal structures within these waves. But yes, you will always have an A, B, C, D, E. If you only get an A, B, C, it's not a triangle. If you get an A, B, C, D, the triangle is not complete. You still need one more wave down. Garrett, how many waves must a triangle have? 5. It has an A, B, C, D, E structure. Sometimes, as I said before, the E wave can also be a triangle, in which case it looks like there's a 9-wave structure because you'll have you know, slightly more oscillation as this goes out. Does he mean 5-way meaning ABC? Sorry. The example charts that I've given, they're various different time frames. Like I said, all these patterns are fractal in nature. They can happen on a monthly chart all the way down to a minute or tick chart. You'll look for these patterns. You know, if I didn't have labels on here, you know, you might not know what time frame this is. And that's kind of the concept behind Elliott wave principle, is that these patterns repeat on all time frames. The market is fractal in nature. So whether you're looking at a monthly, yearly chart or a minute or tick chart, the price action, you know, tends to look very similar. So let's go over the basic rules one more time quickly. In an impulsive wave, the wave 3 may not be the shortest wave. It does not mean that the wave 3 has to be the longest wave, but it often is. 2, wave 2 may not retrace beyond the beginning of a wave 1, and this is true of diagonals as well. Wave 4 may not overlap into wave 1 territory. This is for an impulsive wave, and there is the exception which I went over of diagonals. A diagonal may never be a third wave. So if you are looking at an impulsive wave, 5-wave structure, the third wave cannot have overlapping internals. The 5 waves within that third wave cannot overlap. It cannot be a diagonal. If it does, you're looking at a C wave, and you're not going to get a 4th and 5th wave. So the diagonals may only occur in the 1st or 5th wave positions. I forgot to add as well as the A wave in the case of a leading diagonal, or the C wave position in the case of an ending diagonal in a corrective pattern. Every impulse wave must contain an internal wave structure that subdivides into a separate and complete 5-wave pattern. So if you were looking at a potential 5-wave move up and it starts with 3 waves, you better reassess your count, because that's not a wave 1. That first wave has to be 5 waves. Either it's not complete yet, or you're looking at a corrective move. Even diagonals which overlap, you still notice that they have a 5-wave structure. Hold on. Yes, when I say may, I suppose I probably should have used must. Basic guidelines. Corrective waves often retrace to the previous wave, or previous 4th wave of one lesser degree. So these are some guidelines to use when you're trying to label charts in real time. If you are looking at a 5-wave move and then looking at the wave 2 retrace after that 5-wave move, this is especially true in a wave 2 of 3. It tends to correct to the 4th wave of one lesser degree. So that 5-wave structure, that 4th wave, the 2nd wave will tend to come back to that 4th wave. This is even more true when you are talking about 4th waves of a larger 5-wave structure. So that 4th wave will come back to the 4th wave of the 3rd wave. So one lesser degree, look for the 4th wave, and if you are trying to gauge where a correction is going to go, use that as a guideline to gauge maybe, this is where this correction is heading. Do you have a graph? Yeah, I'll point this out again when I go over an actual count. Waves 2 and 4 of the same degree are rarely the same type of corrective pattern. So this guideline is known as alteration. This helps when you are trying to identify what type of corrective pattern you are looking at. If you had a zigzag in the wave 2 position, you can expect maybe a triangle or a flat wave, a corrective wave, in the 4th wave position. So, it kind of helps that you can generally rule out that a zigzag is not going to happen again in the 4th wave if you had one in the 2nd waves. This isn't a rule. I mean, you can have 2 zigzags in the 2nd and 4th wave position. It's just a guideline and a tendency for 5-wave structures. Triangles are rarely found in 2nd wave positions by themselves. Like I said, they tend to delineate the end of a move. So if you see a triangle, there's likely going to be one more wave out of that triangle, and then that move within that degree, that triangle degree, is going to end. They can be in a 2nd wave position, but it's going to be part of a larger corrective move. So you'll have an A wave, a B wave triangle, and a C wave in that 2nd wave. Wave C in a correction most commonly extends to a length equal to wave A of the same degree. You see this a lot when we're talking on the website and we're trying to give targets for a C wave. The first target we always look at is the A equals C extension. So we measure the A wave, throw some fibs on the top of the B wave, and then look where the C wave would equal the same length as the A wave. When you are trying to figure out where a C wave will possibly target, use this guideline and always look for the 1.0 extension first. Only one wave of 5-wave impulse tends to extend, and it's usually the third wave. Again, guideline, not a rule, but if you have an extended third wave, you can expect the fifth wave will not extend, and the fifth wave will usually equal the same length as the first wave. If the third wave equals the same length as the first wave, then you can expect the fifth wave to extend. The first wave can extend, but it's pretty rare that that happens. Of a 5-wave impulse, wave 5 of an impulse often extends to the length equal to wave 1. So again, if you have a third wave extended move, the wave 3 of a 5-wave structure extends. Look for the fifth wave to equal the same length as the first wave. Wave 2 often retraces 50% or 61.8% of wave 1. This is a general guideline when you're looking for a wave 2 correction. Look for the 50% or the 61.8% retracement, and that's where the wave 2 will tend to stop. Can the third wave extend with a leading diagonal? Yes. As long as the third wave is not the shortest, you can see extensions in a diagonal where the third wave is the longest. It happens, it's not as common because usually diagonals are contracting in size, so the first wave in a diagonal usually is the longest. But as long as the third wave is not the shortest, the third wave in a diagonal can extend. Finally, a wave 4 often retraces 38.2% of wave 3. And usually this will line up with the fourth wave of one lesser degree. So if you're looking for where a wave 4 will retrace, measure or draw your fibs from the bottom of wave 2 to the top of wave 3, which would measure the third wave, and look for the 3.82 or 38.2 retracement. Next we have Avi's methodology of analysis, which is called Fibonacci pinball. Now this is a terrific methodology to use for trading because it gives very accurate targets, especially within the third wave, which tends to be the extended wave of a 5-wave move, and helps you manage your trade perfectly most of the time. So when you have a 5-wave move and you get a wave 1, a wave 2, draw your fibs measuring from the bottom of wave 1 to the top of wave 2, and then place them at the bottom, or sorry, the top of wave 1, and then place them at the bottom of wave 2. So as you can see here, this 0% to the 1.0% is the same length as this wave 1, and then I drew them from the bottom of the wave 2. It would be a great help if you can make a summary of the rules for each wave. Yeah, I can do that. I think I'm running a little long here on the webinar though, so I'm going to try to move quickly through this, but I can do that later. So basically, the way that Fibonacci pinball works is you are looking for where the subwaves of the wave 3 are going to hit. Now the most typical path of a third wave is for the wave 1 of 3 to come to the 0.618 extension. If that happens, then you can expect a wave 2 retrace, usually 50% or 61.8% of that wave 1, or back to the fourth wave of one lesser degree, so whatever the fourth wave within this wave 1 is. And then you will see the next move up, the wave 3 of 3, target the 1, 2, 3, 6 extension. So this is how Avi gives his targets when we are dealing with an impulsive wave pattern. You know, these are very accurate. This tends to happen more often than not. It's a great tool for managing your trades and trying to trade within a 5-wave impulse move. After this happens, after you hit the wave 3 target, which tends to be at the 1, 2, 3, 6 extension, you will typically see the fourth wave retrace back to the 0.764. extension. So somebody just asked, will I go over how these fibs are drawn again? If you have a Fibonacci extension tool in your charting program, you measure from the bottom of wave 1 to the top of wave 1, and then place the Fibonacci extensions at the bottom of wave 2. So this 100% move from 0 to 1.0 is the exact length of this first wave, and then I measured them, or projected them I should say, from the bottom of wave 2. So back to how the wave moves through this pinball, through the fibs, in what Avi calls pinball. After reaching the 1, 2, 3, 6 extension in a wave 3, the fourth wave typically pulls back to the 0.64 extension if it hit the 1, 2, 3, 6 extension. If it pulls back past, let's say that this wave 1 didn't necessarily make it up to the 0.618 extension, and this wave 4 begins to pull back past the 0.618 extension, then that is your first red flag that you are not dealing with a third wave. This is maybe where you want to set your stop loss if you're trying to trade this third wave, or maybe when you want to reassess your trade in terms of whether or not you're going to hit your upside target. Or it should discourage you from entering a trade if you're trying to trade a fifth wave within the third wave if it pulls back past this 0.618 extension. But if it is a true impulse wave and it is a true third wave, it tends to stop at the 0.674 extension, as well as the wave 4 of 1 lesser degree. So if we were to break this third wave up into a 5-wave structure, this would tend to be where the fourth wave within this 5-wave structure ended as well. Next, for the wave 5 of 3, it tends to hit the 1.618 extension. This is the most common target for wave 5 of 3. When this happens, you will usually see a fourth wave retrace. This will come back down to the 1.0 extension, and as you can see in this example, it came back to within the fourth wave of 1 lesser degree. Let me look at some questions real quick. Is it common for wave 1 of 3 to extend the 0.5 versus the 0.382 or 0.618? It happens. I've seen it happen before. That's why I do draw the 0.50 extension, but typically you're looking for it to stop at the 0.382 or the 0.618. The extensions mean the percentage change. So 2.0, yes, so 2.0 would be 200% of this move. Pullbacks to moving averages are typical 2, 4A, or C waves. I don't use moving averages very often in my trading, so I'm not familiar with tendencies of where corrective moves hit in terms of moving averages. So maybe you can ask somebody who uses moving averages with their Elliott wave analysis. I use stock charts fibs, and when I drag them down and find that I can make them go wherever I want, and then I feel they are set wrong. Is there any special way to drag and set? I know this sounds stupid. No, there are no stupid questions. Please ask if you were ever confused. Basically, you're looking to place them and drag those fibs to wherever that wave 2 ended. Why is the 0.0 at the end of 1 of 1 instead of beginning of 1 of 1? And don't worry. It doesn't necessarily have to be where this wave stopped. That's just the way I drew this example. So don't really pay attention to the fact that this wave 1 is hitting at the 0 level. This, when I drew this, I just made this a 618 retrace. This wave 2. Do you consider intraday price swings or just closing prices when drawing your fibs? If you were looking at an intraday chart, you must of course use the wave patterns within that intraday chart. If you are looking at a daily chart, then yeah, you'll be looking at the closing prices. So if you're looking at anything that is at a smaller time frame than a daily chart, then yes, you will be using the wave patterns rather than closing prices. So if there was a stream in the middle of the day that was the true top of wave 1, you have to use that top. When wave 4 is retracing, do you draw extensions again in case it is going to be long subdivided wave? So like I said, there is a tendency for the wave 4 to retrace 38%, 38.2% of this third wave. So I would draw retracement fibs from here to the end of the third wave, and you will find that this fourth wave came back retraced 38.2% of this wave. What about pre-market or after-hour prices? If you are looking at futures, I trade and look at the after-hours prices, and I include them in my wave counts. So does Abby. I usually don't look at pre-market or after-hour when I'm looking at stocks. If I'm unsure of a pattern, or I think that a pattern might be playing out that I'm missing some price data, I'll go look in the after-hours or pre-market data. But typically I don't include pre-market and after-hour when I'm looking at stocks. But futures, yes. Okay, back to the pinball. So after we have made a wave 3 top, which tends to target the 1.618 extension, usually we see a retracement back down to the 1.0 extension for the wave 4. Now after this happens, and you notice that the wave 4 has ended, you have a 3-wave structure, you will next be looking for a 5th wave targeting the 2.0 extension. That is typically where the 5th wave of the entire 5-wave structure will target. So if you are trading long and you've held the trade through this entire time, you decided to hold through this wave 4, and you get up to the 2.0 extension, you should really consider taking profits or having a very tight stop, because that is where it's typically going to end. You can of course see extensions, but this is the usual target that wave 5 will hit. So when it does hit, look for a reversal at this point and look to take profits on your trade, or perhaps look for an entry going in the opposite direction. So once again, going over these fibs, the most typical path of a third wave within a 5-wave structure using Fibonacci pinball is wave 1 of 3 will hit the 0.618. Wave 2 will retrace 0.5 or 0.618 of that first wave. Wave 3 of 3 will usually target the 1.236 extension. Wave 4 will then retrace back to the 0.764 extension. Wave 5 will then usually target the 1.618 extension, and that will end the third wave. The larger fourth wave pullback will usually come back to the 1.0 extension, or the wave 4 of one lesser degree. And then the 5th wave move will usually target the 2.0 extension. Now the same rule for this 4th wave applies as it does to this one. If you start pulling back past the 764 and you start getting to the 618, you should start being very careful that this is perhaps not a third wave and it's a C wave, and you are going to continue down and not have a 5th wave up. There are some variations of Fibonacci pinball that you can watch for, and those are just different price targets. If you see that the first wave of the third wave targets the 0.382 extension and then pulls back into wave 2, then you can expect the third wave of wave 3 to target the 1.0 extension. The 4th wave of 3 will then pull back to the 0.618, and then the 5th wave of the third wave will usually target the 1.382 extension. I have another chart that shows this. I forgot to put it in the webinar, but it is on the trading website, so you can go look at the library and see that chart. It has these different targets for Fibonacci pinball. When that happens, if you only hit the 1.382 for the top of 3, expect the 4th wave to come back to the 764, and then the 5th wave to target the 1.764 extension. Let me look at some questions again. Is it rare for an extension to the 1236 to retrace to the 0.618? It can come back to the 764, but if it goes past that, that is very rare, and it's a red flag that maybe the expected pattern that you thought is not playing out. So again, how to measure these fibs and draw them. You measure from the bottom of wave 1 to the top of wave 1, and then project them from the bottom of wave 2. How far will the ABC retrace after wave 5? Again, remember that these markets are fractal. These patterns are fractal. So let's pretend that this whole 5-wave structure is just this smaller 5-wave structure here. Again, the wave 2, if this is part of a larger 5-wave move, is going to retrace typically 50 to 61.8% of that first wave. Yes, this webinar is being recorded and it will be available later for you to view again. All right. Okay. I'm sorry this is taking so long, guys. I hope that it's not getting too boring. I do want to go over the very last part of the presentation, which I think is going to be the most helpful. I know I've gone over the time extensively, so please bear with me. All right. So now we are going to go over a count in real time. I think this is going to be the most teachable portion of the webinars. Every time I'll pick a chart and we will count it and how to trade it. Going through a chart as if it was in real time. So, unfortunately I don't have the price data of this chart going back further than this available right now. But let's just say that we had an A wave up, and this is a part of a corrective B wave retrace. And we were looking for a target around this red line for the B wave to stop. So we're looking for a turning point right here. We have a 5-wave C wave structure. We're looking for the turn and hit our target. So right now we're going to look for a 5-wave move up, and hopefully then we can start trading it. So let's move through this as if the market was going in real time. So it bounced off of our fib. It looks like it's starting to move back up. We might see a change in direction here. However, I wouldn't necessarily suggest, initiating a long position just yet. As somebody pointed out, yes, we see divergence. The technicals are looking nice. This hopefully is the end of our correction. So we're going to keep moving along here. It looks like we might have a first wave. Well, let me see if I can move these since I need to be able to. There's a bunch of windows in my way. And I need to be able to adjust the scaling here. Now this is a daily chart. It's kind of difficult to see, but we have a possible 5 waves here. If you can see here, we have a wave 1, and then this bar retraced as a wave 2. And then we have a third wave up, a very small retrace, and then a small wave 5. So it's possible that we have a wave 1 here. So we're going to watch for a wave 2 retrace. And let's see what we get. We have an A wave down, a possible B wave up, and then one more wave down. So this might be the end of our wave 2. Let's draw some fibs here. Again, this is a daily chart. You would probably go through and check smaller time frames to look at these wave structures. But I just drew some retracement fibs measuring from the bottom of what I think is the first wave to the top of what I think the first wave is. And we can see that this 3-wave move stopped right at the 618, the typical retracement of a wave 2. So we can assume right now that this is a wave 1 and 2, or at least I'm going to make that assumption. If you're an extremely aggressive trader, you might initiate a long position right here. If you're a more conservative trader, you're going to wait for a larger degree 5-wave move to happen and then buy the next retrace. So right now, if we're going to use our Fibonacci pinball, If you noticed, I drew, let me do that one more time as I'll walk you through it. From the very beginning of the wave 1 as my first swing point to the top of wave 1, and then I'm going to project them from the bottom of wave 2. So now we have our fibs that we can hopefully play pinball with. So let's watch how this, let's say we're long, and we're looking for the first move to hit the 382. I drew these a little late. We might already have a first wave in here in a retrace. We came up a little past the 382. Somebody asked earlier if it sometimes hits the .50. It's possible. This might be one of those cases. But let's see how this progresses. So we have a possible wave 1, a possible wave 2 of 3, and a nice third wave. So if we were long, this would be a nice profit. It hit the 1, 2, 3, 6, the typical extension that you look for in a wave 3 of 3. This is, you have a gap here. This is typical third wave action. You see nice strong technicals, no divergence yet. This is a very high probability top of a wave 3 of 3. And we were looking for a retrace back down. Uh-oh, it went past our 764. Now this would initially be concerning as long as we don't have overlap and the 618 holds, then we should be okay. But it went a little past, you know, we might be slightly nervous of the trade if we're still long. That's why I like to take profits at the top of a wave 3 of 3, at least partial profits, if I did try to decide to trade this. But as long as we don't retrace back below this wave 1 of 3 and past the 618, we should be okay. So let's see how this continues. Good. It stopped here. It did not break the 618, and we have another wave up. Now this could be our fifth wave. If it is, we're looking for a target to the 1618. So let's see if we get up there. This is looking less like an impulsive wave, so we might have an expanded flat B wave here, which this is just a B wave up. And now we have our fifth wave moving up to the 618. So this is typically where we would have the top of our wave 3. So we have a wave 1, 2, 3. And I purposely wanted to label these so you can follow along. Bear with me 1 second. So I'm just using pinball to place my labels right now. So this is likely, since we have only 3 waves in here, this is likely the end of the C wave, and we had a running flat. So this is an A wave down, a B wave up, and a C wave back down as a wave 4 of 3. And this is the top of our third wave. Somebody was saying that they see divergences in the oscillator. That's not uncommon. You'll see the strongest technicals in the wave 3 of 3. So you'll start, in some cases, to see some divergence, even at the top of a wave 3 and the wave 5 of 3. So nothing to really get concerned about right now. So we're thinking that we have a third wave top here. We're expecting a retrace back to the 1.0 extension, if you remember from the fib pinball. It looks like this is extending here, and we actually have a more clear 5-wave structure. So it looks like we have an extended third wave move here. So I'm now going to move my 5th wave up here. This is likely where the end of the third wave is. It came up to the next fib up here, which is the 2.0 extension. We have a nice 5-wave structure in here. If you were long, again, this is a good place to take profits, at least partial profits. You can see it bounced off of this 2.0 extension. It's retracing back in what we should think is a wave 4. Again, we're still probably going to target the 1.0 extension because we're looking for a retrace at least back to wave 4 of 1 lesser degree. And it looks like we might have had a diagonal here. Again, another shallow retrace. We have this overlapping pattern up here that hits one higher fib. We might have a complete 5-wave structure. So, if you had not traded this, if you're a more conservative trader, and you saw this play out, and then this sharp retrace coming back from it, then you will be watching this retrace for an entry. So now that we have a possible 5 waves up, we can draw our wave 2 fib retracements. We're looking for it either to stop at the 0.50 or the 0.618. We have a 3-wave move here, possibly an A wave, followed by a B wave back up. Again, we can look for Fibonacci relationships between the A and C wave to help give us a more exact target. It looks like we have a nice confluence right here between these two fibs at the 618. It matches up with the 1382 extension of this A wave. So if I were to label this, we'd have an A, B. We're looking for our C wave to target this level right here. Let me grab this label up here. So this is our larger wave 1. We're looking for an end of our wave 2 here. So typically we will be watching for positive divergence on the indicators. Right now we only have one on this one, which is the composite index. We're looking for a complete 5-wave structure in our C wave, and we're looking at these fibs as a possible entry. So as we approach it, we're not really getting much positive divergence. You know, it would be really aggressive if you were to set a buy limit right here. If you wanted to do so and you are an aggressive trader, that's fine. You can set a stop limit or a stop loss right below the start of this 5-wave structure. But let's see what happens. You know, if we don't bottom tick a corrective move, it's not the end of the world. We can always get in later. So without positive divergence, I might personally hesitate taking this trade. You know, if I was going to take it, we don't have any positive divergence. If I was going to take it, I would probably, you know, it would just be the start of a position. It would be a partial position. So far we have a bounce from where we were targeting, which is a good initial sign. This could be the end of our wave 2. If we are trading long and we see that this level is held, we might now take a position with a stop loss right below here. We didn't bottom tick it, but you know, at least we made sure that this was possibly going to at least stop at this fib target we had. So far we're having a nice move coming off of that. It's a good indication that this might very well be our bottom. The oscillators are moving up incredibly strongly. You know, if we did go long here, that's looking good, and if we bottom tick this, maybe we would move our stop level up from below the 5 waves to the bottom of here, just below this C wave of wave 2. If you haven't gotten long yet, you know, you'll wait for a retrace after this move to go ahead and initiate a position. So you might buy around here if you want to get long, because we have a possible 5 waves up here wave 1, 2, a small fourth wave retrace. Oops. And we should be playing pinball again, so let me draw those fibs. So we had a move that came up and targeted the 382. It's possible wave 1 of 3. This retrace might have been a buy area for you. It looks like it retraced about half, 50% of that first wave. If you did get long, now we have a nice move up. There was some, there was no divergence really. It's a good initial sign. So far, this looks like it's pulling back a little deep. You know, if we got long here, maybe we set our stop loss here, maybe we put it here, depending on how much risk tolerance you have. You might have gotten stopped out on this move. See how this progresses. We still have a possible diagonal here, so the count's not necessarily invalidated by any means. Again, if you're aggressive, maybe you took another long position here. So now we're getting some nice movement coming up. We probably hit the top of our wave 1 in a diagonal. This might be our wave 2. This is a wave 1 and 2 of the next wave degree lower. Again, we can draw some fibs here to see how this plays with them. So if we were long, you know, so far this is looking nice. For our wave 3, again, we're targeting the 1, 2, 3, 6 extension. We came up to that, almost touched it. It looks like we have a 5-wave structure here. So this could very well be our wave 3 of 3. You might have wanted to take some partial profits here. It also hit the 2.0 extension of this wave degree. So, you know, there was some nice confluence up here as a possible top of a wave 3. We get a pullback here. It looks like we are not done with this move just yet. We went up to the next fib level, which means that this probably wasn't, if you look closely, it was a 3-wave move. This probably wasn't an impulsive wave. This probably was another expanded or running flat. So we have a wave 1, 2, 3, 4, 5. It extended a little past the typical target. And we now have a possible wave 3 top up there. Again, you can obviously get extensions when looking at a 3rd wave move. It's possible also we had a shallow retrace. We're starting to get some divergence here on our indicators. So for now, I'm going to label this as our wave 4. Our target was the 618. It's moved past that already. Our next target is the 1764. Looks like we're topping out here. Oscillators are turning down. This looks like the top of a wave 5 of 3. Is it possible for me to download to my computer only? Yes, this will be recorded and you can watch this at your own pace. Again, please ask questions as I'm going along if anything is confusing to you. This is just how I personally would trade a potential 5-wave move up and play fib pinball as we go along. What is my top indicator? The top indicator is the MACD. This is a combination of stochastics and RSI, and this is the composite index. So we have a possible third wave move here, some divergences. Our wave 3 of 3 of 3 had the strongest technicals. We got a 5-wave move up here, a diagonal, followed by wave 2, followed by wave 3 that hit on 1382, a wave 4 that came down to the 1.0, and then a 5th wave that came up to the 1764. I'm going to go ahead and start labeling this as the end of a move. I'm going to move these labels around a little bit, sorry. So I'm going to count this as wave 1. We already know this is wave 2. We have potential top in a wave 3. Now we're going to look for a retrace back to the 1.0 extension, as well as the 382 retracement of this third wave. If you see the 382 matches right with the wave 4 of 1 previous degree, it would be a good target to expect this fourth wave to pull back between one of these two fibs. Looking at a possible A wave down. The B wave move up. And then our C wave, we can do the A equals C relationships, Fibonacci relationships with our A wave to our C wave. Looks like our 1.0 is right here, so we would probably watch this level first. The other fibs are still pointing down here, so we do have some confluence down here. I'm still going to expect it to pull it back down to one of these two levels here. Looks like we went just below the 1.0 and are starting to turn up. So looks pretty promising so far that we have a fourth wave in here. If you decided to hold on to your long position through this retrace, or maybe you only sold partial profits up here, now you're looking for a fifth wave that's going to target the 2.0. Now this third wave went past the 1618, so I mean it's very possible that we are targeting one fib higher here rather than 2.0. We can also look for some of the other guidelines that I mentioned, which is that the fifth wave should equal the length of the first wave. So again, this is right around, this 100% extension is right around the 2.0. I mean, this is a nice target if we're long still to take profits or tighten our stops. Looks like we have a wave 1 and 2 of 5. We're working on the third wave. We came up here. I would definitely be taking profits and tightening my stop. We have a possible wave 4 right here. I might put my stop loss right below that for the rest of my position, see what happens. We made one little spike higher just to perfectly hit that 1.0. Doesn't necessarily mean we have a top yet, but I would probably be out of my long position at this point. You know, you don't necessarily have to catch 100% of the move. What would be helpful is if you would label the projected waves based on the fibs and then see how well... Okay, I'll do that on this next move, sorry. Could this be an extended wave C of an ABC? When do you start considering that possibility? When I see technicals in a supposed third wave that are stronger than the first wave, when I see a move that goes past the 1618 extension, you know, and there's not glaring negative divergence or there's nice clean 5-wave structures in here, that's when I am going to assume it's third wave. If I saw a divergence, the technicals here didn't make it above this high, then I would be a lot more cautious that we were dealing with a C wave rather than a third wave. So again, sorry, this fifth wave, we just met our initial target. Again, it can extend higher, but I'm personally not going to trade it. I'm out of my position. If I don't hit the top, no big deal. I can get in on the next retrace. So we're moving a little bit higher here. Possibly this is our top. Looks pretty good. The biggest challenge I have is identifying the start of a first major wave. Can you help show this? So what you want to look for to identify this initial wave 1 is a 5-wave move after a corrective retrace. So we know that, I don't have the price data looking back, I'm sorry, but if you do look back, you can see there's a nice 3-wave move here. We were expecting a B wave in this target area. The C wave is complete. We have 5 waves down. Once you have a 5-wave move up, after a completed corrective move, you're expecting a C wave up here because you had an A wave, back a few years ago, and then a B wave retrace that looked corrective. That's when you can go ahead and safely say that you probably have a wave 1. It hit your target. You have a completed corrective pattern. There's 5 waves in your first wave. It pulls back correctively and holds support. That's when you can establish your long position. What software are you using to do the fib retracements on the large? Oh, this is the software I use is called Wave 59. There are various other software programs that do Fibonacci retracements and Fibonacci extensions. So go ahead and check. If yours doesn't, I can maybe point you to some other programs if you want after the webinar. Looks like we're probably not done with our 5th wave, or we're making a higher B wave, but this looks like a pretty strong move so far. It's very possible this is a small wave 2. This was the top of a wave 3 of 5. Go ahead and label this. And we're getting a 5th wave move up here. The next extension we're going to look for is one of these two. It's possible it moves all the way up to the 2618. I'm not in my long position anymore. I don't really care. I'm not going to chase this. I know it's the end of a move. We have divergence. We have a 5-wave structure here. I'm waiting for the next larger retrace to re-enter long. It looks like we stopped perfectly at this 2236. So I'm going to go ahead and label this right now. The top of our 5th wave. Now remember, markets are fractal in nature. So this 5th wave can be the wave 1 of a larger 5 waves. If I did have the previous price data to go back and look at on this chart, you'll notice that the A wave that I was looking at this to be a C wave. The A wave that preceded this move and the B wave retrace were much larger than this initial 5-wave move. So I don't think that this is the end of the C wave. I think this is just wave 1 of the C wave. If we retrace correctively, it's a good sign that I can re-enter long again. I'm really sorry that I can't go back further in the chart. I don't have the price data. So we hit a top here. We're starting to retrace another move up. I'm really skeptical that this is still part of the impulse. We have a 5-wave structure here. This would make an extremely extended 5th wave of this larger 5th wave. So, it's very possible this is just a B wave. And it looks like it was. Getting a strong retrace back down of possible A, B. We can move these fibs since we've already done our full 5 waves. If we're looking at this as the top, we draw our wave 2 retracement fibs from there. Again, this is why it's very important to recognize the actual structures of a 5-wave move rather than just doing from actual unorthodox tops. We are getting a very strong move down. This could be a wave 1 and 2 of an A wave. So this might be a wave 3 of an A wave. Wave 4 of the A wave. Wave 5. Ooh, we have a strong wave. This can't be a 5-wave move actually, sorry. Because the wave 2 retraced past the top of here. So right now we have either a higher B wave and a possible larger A wave. So we have an ABC structure here. Do I have a general minimum length of time that you've charted something before you have confidence in future action? The more price data you have to look back on in the past, the better, because you can look at what the established long-term trend is. If you can get a solid count on that, then you have a better idea of what these subwave structures might be doing and possible paths that they might take. So again, the more price data you have, the better. So right now I'm going to count this as a 3-wave ABC A wave, followed by a 3-wave B wave. We're starting to get some positive divergence on these two indicators. Doesn't look like we're going to get any on the MACD. So again, I might be somewhat hesitant to take this trade right at the 618. The second set of fibs that I drew are an extension of the A wave drawn from the top of the B wave. We're looking for a Fibonacci relationship between this A wave and a potential C wave. So again, we were looking for our wave 2 to come down to the 618 retracement. It doesn't really look like there's any confluence here. It's not a trade that I would take personally. I would not go long here. I would wait for price to turn around and give me some sort of indication of bottom. So this is good. To make sure this is not a 4th wave, we need to see it take out this price extreme right here, because this could be a possible wave 1, 2, 3, and now we're in a 4th wave of the C wave. So once it takes out this, it's a good indication that we have a bottom. We got some positive divergence on these two indicators, not on the MACD. Not perfect, but there we go. So now we just took out that price extreme here, which was a possible wave 1 of C down or something even more bearish. This is looking very good as our wave 2 ending. So I probably wouldn't have initiated a trade yet. I'm going to try to look for a retrace to enter long again. This looks like a 5-wave move starting here. We have a possible wave 1, 2, 3, 4, 5. Getting some nice extensions, so it's very possible this is the top of a 3rd wave. This would be wave 1, 2, wave 1 of 3, wave 2 of 3, wave 3 of 3, wave 4 of 3. And this looks pretty good for a top. This probably counts best as the 3rd wave right here with an extended 5th wave. As long as this 3rd wave isn't shorter than this wave 1, it doesn't look like it is. Now this is the retracement that I'm looking for to enter long. I'm going to draw some fibs here and see what I get. So again, this is a wave 2 of 3. We're looking for a wave, a retrace back to the 618, the wave 4 of 1 prior degree. So I'll be watching these 2 levels first for a possible turnaround. Looks like it might have come just shy here. You know, I probably would have placed my entry here if I didn't get filled. Not the end of the world. How do I handle stops that miss with overnight gaps up or down as you are trading the pattern? It depends on your risk tolerance. If you think that a stop, there's a potential stop that can take you out overnight that would allow for a loss that exceeds your risk tolerance, then you need to rethink your trading strategy. You know, it's something that happens with stocks. It's one reason I like to trade futures, but it's a risk that you have to take with trading. After wave 1, the ABC has ceased so far out of proportion it makes my point of computers causing far greater moves as they take out stops. B looks like a failure that turned. We'll see in a few moments as the chart updates. This looks like it came just short of a 5-0. Again, I might not have a long position here. Not the end of the world. A wave 3 is usually the most extended wave. I can always look for another potential entry. So it's pretty good on our fib pinball that our wave 1 came pretty close to the 618 extension. That's the typical target that we would be looking for. Sorry to squash this down on you. So again, we're going to be looking for a wave 3 to target the 1, 2, 3, 6. The wave 4 to pull back to the 764. The wave 5 to target the 1, 6, 1, 8. And this would be the top of our larger wave 3. So again, I don't have a long position yet. I'm waiting for a retrace. I can do smaller fib pinball on this wave 1 and 2 of 3. We're at the 618. Hopefully we can pull back here and I can get long. Looks like we exceeded it a little bit. Again, I don't personally like to chase. We went past the 1764, but it looks like we're retracing nicely. Here's where I would look to initiate a long position. I'm going to draw some retracement fibs right here. I'm going to put a buy limit at the 618 here. So if this hits, I get filled. Hopefully I got filled on that hit. It came close enough. If I was watching this daily, then I would, you know, maybe move it up just to catch that move, just slightly. So again, this is what we're looking at. Possible wave 1 and 2 of our larger third wave. Why didn't you go long at the start of wave 3? If you remember, you know, this move down was pretty strong. There was some divergence. If you're a really aggressive trader, you can go long there. I personally, you know, unless the move looks like it's slowing down, we have positive divergence. We didn't on the MACD. You know, it depends on the type of trader you are. I mean, personally, I like to buy pullbacks. I do enter at fibs, but only if the pattern looks like it's ending at that fib. There, like I said, Elliott wave principle is not a trading strategy or trading methodology in and of itself. It's a tool for analyzing the markets, for looking for targets, looking for invalidations of expectations, and where to set your stop. So it really depends on your trading style, how you want to trade things. You know, maybe I would have bought this breakout above the B wave. You know, it depends on your trading style. So, okay, then we buy the wave 2 pullback of wave 3. Again, I was looking for this pullback to buy. I was looking for it to at least hit the 5-0 retrace. It didn't quite make it there. Again, if you're aggressive, you could have, you know, bought this retrace a little higher. I might have missed it. It's not the end of the world. Like I said, third waves are the strongest and most extended move. There's still plenty of time to get in. Here I waited for the wave 2 retracement after this wave 1 up. It came down to a standard retracement level. I was able to get filled. I would now be long from this point. My stop is going to be just below this low right here. Because if we make a new low, I know that this cannot be wave 1 of this 3. Remember, wave 2 cannot retrace past the beginning of wave 1. So my stop would be just below here. I got filled right here. Let's see how this turns out. Again, I'm just putting my labels at the standard extension levels. It looks like we had a strong, you know, wave 1 move up here. So it's very possible that this is going to extend, this wave 3 is going to extend past this 1, 2, 3, 6. But again, you know, I'm looking for standard targets so far. After 1, you are looking for a flat. Wave C of the flat is 2618, I think, of a flat. This is what HFTs and algos have done, as you never saw this violence and corrections before their arrival. I can't really comment about HFTs and algos. I mean, they were made by humans, so in my belief, they are still going to follow the wave principle. They have human tendencies, even though they're computer and, you know, supposedly emotionless. It's my assumption that because they were made by humans, the wave principle will still hold true, and, you know, I've continued to see it work even with a algo and HFT driven market. You know, you've seen the accuracy that Avi still has. I don't think that it really ruins the wave principle. It might have been easier to trade before their arrival, but, you know, there's nothing really you can do about it. So, all right. So I'm long now. I'm looking for a move up initially to the 1, 2, 3, 6. See what we get. My stop again, just below this low. Looks like we have a possible 5-wave move up here. Again, going 1 degree lower. This is another 1, 2. We're getting a strong move up in a clear third wave here. In the smaller fibs, we hit the 1, 2, 3, 6 retracement. This is possibly the top of our wave 3 of 3. I'm going to go ahead and say it's not likely because that would mean it would have to hold this top. So we're probably going to extend higher. It looks like we only have 3 waves in here. If you see this, wave 1, 2, possible 3. So I'm looking for one more high, really, for this wave 3. It looks like it went past the 1382 extension slightly. It might be targeting the 1618. Again, I'm long. I have no reason to get out of my position. There's no divergence on the MACD. It looks like there's slight divergence developing here, but it seems like a pretty strong move. I'm expecting it to be a third wave. Maybe I raise my stop up from here to here now. Maybe under here, under these lows, because this would be another wave 2 of smaller degree. Again, Like I said, it looked like it was targeting one higher fib. And we are getting a very nice extended third wave, and it looks like it just ended. So our typical, remember we were looking for a move to the 1, 2, 3, 6. It overshot it just slightly. You can see how well these targets work. I was looking for that target back when I got long here. So, you know, this whole move I expected. Again, this is still might not be over because we could have a wave 1, 2, 3, 4. And yeah, looks like we're still going up, and we're going to hit the next fib up. Again, I'm just going to keep moving my price levels up. I have no reason to get out of my long position. If I want to take partial profits up here, since we have a 5-wave move up of this third wave, I can do so. Depends on your trading style again. You know, maybe tighten stops on a partial position. Depends how you want to trade it. Nice hit on this fib. Like I said, in stronger trending markets, they can, you know, you just look one fib up. We have a 5-wave structure here. This looks like the top of our wave 3. Our wave 3 of 3 had the highest technicals. We're getting some divergence in the MACD. This is taking out the divergence we had on these other two indicators. We're still looking good for a strong trend upward. Again, depending on your trading style, maybe you took some partial profits here, left the rest of your position on. But right now I'm going to be expecting a wave 4 retrace back to the 1.0. Because it went higher, I'm going to move one fib up higher as well for my wave 4 on its retracement. I can draw some retracement fibs between my waves 2 and 3 to measure the wave 3. The 382 lines up perfectly with that 1.0 extension. This is my target for the 4th wave pullback. I'm sorry, I should probably move this back to here. I was labeling that incorrectly, my apologies. Looks like we have an A wave down, possibly. B wave retrace back up. Oh, and a strong spike. This is why, you know, the trend looked good. I maybe took partial profits, but I didn't get out of my position entirely. It's possible we had a very shallow fourth wave right here. Again, we're starting to get some divergence on the indicators. This tells us we're nearing the end of our 5-wave move right here. That's why I have this labeled as the top of 3 of 3. On the MACD, it is the strongest technicals. We could have gotten a very, very shallow wave 4 retrace, and we are now in the next move up. It would hit our first target, but it only looks like we have 3 waves. The rest of the move has been extending. I'm going to go ahead and move this target up at least one more fib. One, 2. This looks like a 3rd wave and our 5th wave. And this could be a higher B wave. I mean, we don't have a nice 5-wave structure forming here, so I would start to get slightly nervous with my long position. I might set my stop now under this 4th wave or this 4th wave. We're still trending higher. We hit the 618. The move is not pretty. Could be a B wave. It's hard to tell for certain. I mean, and we could be dealing with some sort of diagonal here. This would be the expanding variety. We have a 1, 2, 3, 4, 5. And this is our top. Or we have a smaller wave 1 and 2 that's hidden down here. And this is an expanded. No, it needs to be diagonal. Yeah, this is probably how I would label it. There's a small 1, 2 right there. A third wave move. Fourth wave retrace. 1, 2, 3, 4, 5 wave diagonal. So we do have a definite diagonal here. It means we're probably near. Again, if you remember, a diagonal marks a possible trend change. So after a diagonal, you're going to look for a change in trend, which means that this is probably the top of our wave 3. It came up right to the 1618 extension. That's our typical target. If I was long, I probably would have taken the rest of my profits up there. Or at least, have a tight stop. And let's see how this progresses. Again, I'm going to be looking for a pullback in this fourth wave to the 382 in the 1.0 extension. Again, they're lining up pretty nicely. This is where I am going to look to get long again, because I'm still expecting, there was no divergences on this third wave. It looks like a nice, strongly trending move. It played with the fib pinball pretty well. I'm pretty convinced this is the third wave. This move down is going to be corrective, and we're still going to have a fifth wave up. Again, that fifth wave, my target would be the 2.0 extension. If you remember earlier, I was saying that I'm expecting this to be a C wave. So right now I'm looking for a three-wave corrective pattern into the 1.0 and the 382 to get long again. Wow, we have very steep drop right there. Again, not something I would buy. This is a possible third wave down, if you can see here. I mean, this could be a three-wave move and then a C wave, but this is really strong. Not something I step in front of personally. We did stop here. This is where we're expecting it to stop. If it can consolidate here and move up nicely, maybe I'll buy the next pullback. Looks like we're pulling back a little more. The next fib we're going to be watching for is the 764. This is starting to look like a five-wave move. Again, I'm not going to be going long just yet. We're starting to get a little reversal. Maybe this is a B wave. Again, this could just be a fourth wave of a five-wave move. There we go. This is what I wanted to see. So again, I'm not long. It wasn't the best pattern. If I miss this whole fifth wave, so be it. I can always go to a different chart and look for something better. This retraced a little bit further than I would have liked to see. It was a pretty strong and almost impulsive looking move. So, there's a good possibility that there was a possibility at least that, this is something more bearish. This could have been a C wave. Again, we have a very nice strong move back up out of this. It's a nice reversal, so I'm more confident now that we have a fifth wave and I can buy the next pullback. Let's see if it's playing with Fibonacci pinball. hit the 1764. I might place my limit order right here at the 1.0 because this is my expectation. If this is a fourth wave, to pull back to the 1.0. I have a nice trade setup here because there's very little room that I can allow this pullback to have before it's invalidated, so I can set my stop just below this high right here. I'm going to set a limit order to buy right at this 1.0. We're getting the pullback here. It's coming up to the 1.0. I get filled. I now place my stop right below this high. You mentioned a diagonal into the top which should retrace hard, correct? Or this has been a double XX top with a drop after one being X. XX means ZZ. It looks like, see, this was our top. Again, yeah, you were right. We had a diagonal. We were expecting the end of a move. Usually they're a sharp retrace that will retrace at least back to the start of a diagonal, which was right here. It did that. It looked like an initial three-wave move, so this would be considered an A wave, a B wave, and a very extended C wave. It wasn't the best setup. That's why I did not decide to go long here. If you were super aggressive, you could have set your buy limit here with the stop just below the top of wave one. Personally, it's not my trading style. I do trust the fibs. I trust the fibs, but I also trust the patterns. You have to look at the patterns. When this looks like a potential strong move down, then you have to be cautious. Again, this all depends on your trading style. If you're super aggressive and you want to put your buy limit right at the 1.0 and the stop just below the top of this wave, by all means, go ahead. It's just personally not my trading style. So, again, I just decided instead to buy this pullback. I mean, I missed, let's see, I got filled right here because I was expecting it to pull back to the 1.0. I have a very, very tight stop I can allow because if it pulls back past this top, then, you know, it's not a 5-wave structure, and this is probably a B wave, and we're heading lower. So, you know, this personally seems like a much better setup to me. This stop here is a lot wider. This was a potential bearish move coming to fruition. Just my trading style to buy this pullback instead of trying to buy into this drop. So let's say I got filled right here at the 1.0, and now we're moving up nicely in a fifth wave, hopefully. Looks like a diagonal. If you can see here how that fourth wave came back below here. Looks like we have a diagonal. Because of that, maybe I would take small profits. You know, we're coming up to where we should be targeting, the 2.0, and between the 236. I might take small profits because I'm expecting it to, according to the rules of a diagonal or guidelines, retrace all the way back to where I bought. So not a bad idea to take profits on this. Looks like we're still, you know, I took some profits. Not the end of the world, and I'm not, you know, still don't have my full position if this just continues up. Yes, the MACD should have negative divergence on this next high. I'm looking for a target up here. Does 4 likely have a MACD divergence? 4, if you can see here, I don't know if you're familiar with some technical analysis, but there's something called hidden divergence. And if you make a higher low than the previous low on the MACD, and the MACD makes a lower low, it is actually bullish. So this is called hidden divergence. We made a higher low, but the MACD made a lower low. You know, it really worked off any overbought signals and stuff. So we might actually just have, you know, a large ending diagonal. This could just be the wave 1, 2. 1, 2, 3, 4, and we're just, this whole diagonal is going to push up to our target. See what happens. this is consolidating here. It's flagging. This is definitely a corrective move. Of what degree? I'm not entirely certain. Again, this could be an expanding diagonal. I'm not going to take off any of my position. I already took partial profits right here. And my stop is still, the rest of my position, I'll let it ride. I'm basically playing with house money right now. I'll put my stop at break even, see if I can hit the target or not. If not, I still had a great trade in this third wave and, partial profits in this fifth wave right here. So again, this move was consolidating. It looked like 3 waves. It didn't look impulsive down yet. We're getting divergences. We're coming up to our target. If this gets hit, I am pulling off the rest of my position. Right there. I would be out of my longs. This is our target of our fifth wave, right at the 2.0 extension. This whole thing is pretty overlapping and a mess. It kind of, could be a diagonal. Maybe it's not. Maybe this is some sort of third wave. This is wave 1, 2, 3, 4, 5. I mean, look at this overlapping action up here, the price action. We're starting to get to a top. I'm out of my longs. We hit the target. If it keeps moving, so be it. I don't always try to catch the very top of moves. Quick question. Are you saying that when wave 4 hits a fib, there was a reasonable chance your basic wave count would be invalidated, and therefore wave 5 would not happen? The only real way we would know that this count was completely invalidated is if this wave 4 move retraced back below the top of this wave 1. Remember, in a standard impulse, wave 4s cannot retrace back into wave 1 territory. So if you're really aggressive and you did decide to buy this, you would set your stop just below the top of this wave 1. I'm not going to be answering any specific questions about silver or VXX right now. You can ask those questions on the trading board, and I'll look at them later. There is one other possibility I see here, and that's that the wave 3 and 4 is right here. We had a small wave 1 and 2, 3 and 4 of this third wave. An extended fifth wave is diagonal. This was the fourth wave, and now we're topping up here. Again, out of my longs. I had a nice trade going. No reason to take on extra risk. If I don't get the very, if I don't top ticket, so be it. See what happens. Looks like I did top ticket. Look at that move down. We now have 5 waves completed up. If you look back at the previous pattern, again, I'm sorry I can't show this to you. Maybe I can bring it up on the trading board later if I can get the price data. We had a C wave up. We're looking for a strong move down. Maybe this next retrace I'll short. Would you normally check your wave 2 and 4 as you finish your fourth to validate? I'm not sure what you mean by that question, but there is a tendency that if you retrace past the fourth wave of your previous move, that you're likely in a trend change. So right here, if we retrace past here, we're likely in a new trend change of, this 5-wave degree, the same degree as that 5 waves. So again, we get a nice, really strong move down. This looks like a third wave. We have 5 waves up. I'm expecting this to go a lot further down, because this was the top of a C wave. So if I want to short this, maybe I look for a retrace if we get one. Maybe I initiate a short position there. It looks like we are running pretty late on time. I went through the 5-wave structure. So if there are any questions before I end the webinar, go ahead and ask. The chart that this was Morgan Stanley. No, it was not Apple. This chart was Morgan Stanley between May 11th of 2005 to June 18th of 2007. The symbol is MS. Uh, Again, I'm going to try to end the webinar here, so if anybody else has other questions, feel free to ask them. Again, I apologize for going way over the time limit. I'll try to manage my time better for the next webinar. Thank you, Rebecca. What would I say are my top 3 charting mistakes? Good question. My top 3 charting mistakes. I would probably say that my top 3 charting mistakes is relying too heavily on diagonals. I see them all the time these days, and I guess maybe I tend to see a potential diagonal and think it's a wave 1. Not necessarily the diagonal's finished, but what is actually a corrective move up, I look at and see that, I see a diagonal and say, oh, if, we retrace here, then maybe I can trade this long. Another mistake is counting corrections as complete too early. If I think of some other ones, I'll post them on the trading room. That's all I can think of right now. By percentage, how do you stage into a wave? Set percentage and then more on confirmation of the wave. Sometimes I scale. I mean, it depends on the instrument. If it has wild price swings, maybe I scale into it, because it's going to retrace or, past standard extensions, or it's going to move past standard extensions. So I might, for something like VXX or something that's a lot more volatile like silver, average into a position, as it comes down to certain fib levels. If I'm expecting a retrace to the 5.0, maybe I buy half a position there. If it keeps going, I buy another half at the 618, and then my stop will be just below the beginning of the first wave. Can subscribers ask questions of this nature during the day, or would you have part of the board? Oh yeah, no. Go ahead and ask any questions you want. If you don't want to clutter the board, you can always private message me. But yeah, feel free to ask questions whenever. And I really encourage those who are starting to learn EW to try some counts on their own. Pick a chart that hasn't been charted on the board yet and try to do a count on it. And you can email it to me and I'll look over it for you. I cannot always see what you are mousing over, so I still don't have a good understanding of the technicals you were talking about. Perhaps spend more time on technicals in the future. Oh, you can't see this cursor very well? Basically, what you're looking for concerning technicals is the wave 3 of 3. So that would be this wave right here. Sorry. Oops. And this wave right here should have the strongest technicals within one higher degree. And this third wave, which is a third of a larger third, should have the strongest technicals of the whole move. And if you can see right here on the MACD, it did. So that's what I mean by technicals. You could notice that you're probably starting to get a fourth wave if the technicals start diverging as you're moving up. That means it's a fifth wave of some degree. You use the previous patterns that you've gotten to that point in the price pattern to determine what degree that fifth wave is in. Would I break it up into 3 short webinars? I'll try. For the next webinar, I'm sorry I didn't manage the time for this webinar very well. For the next webinar, I will try to spend more time doing the actual counting. I think, again, yeah, this is probably the most useful part of the webinar is to, watch how a count proceeds in real time. It's easier to go back and look at a chart and be like, oh yeah, this looks like a wave 1, 2, 3, 4, 5. But to recognize it as it's happening, because that's what you need to do to actually trade it, I think is the most important part. So I will try to spend more time going over the actual count next time. Maybe I'll spend a little less time explaining the theory like I did in this first webinar. I don't think many people found that as interesting as I did when I was reading it. For some reason, it's something that really interests me, so I thought that it helps my trading in my approach to trading, knowing the theory behind webinar and how psychology works. You know, because it gets you to stop thinking in terms of, you know, market moves are irrational and this can't keep going up forever, and you know, the market should be tanking right now and it's not. Why not? It makes you kind of stray away from buying or trading based on fundamental reasons and just following pure price movement, which is, I believe, the best way and most successful way to trade. Are there any other questions, perhaps? For those who didn't enjoy it, I'm still going to do it in the future webinars. I'll just try to make it a little less involved and spend less time on it. If anybody is more interested in the theory side of it, I really recommend getting Prechter's book called The Wave Principle of Human Social Behavior. It's under the further readings in Abby's webinar, in the trading room. You know, it goes over all the aspects of the theory, and you know, Prechter has done an amazing job kind of fleshing out the theory that was originally started by Elliott. So it's an amazing read. It really opened my eyes to how financial markets work, in my opinion, and why the Elliott wave principle works and is a terrific trading method if used correctly. Why is Prechter so bad at trading? You know what? Good question. Because in a number of his books, he talks about not holding a bias when it comes to counting and being able to admit when you're wrong. But for some reason, he can't heed his own advice. I think he has kind of a vendetta when he thought that he called the top of the Dow Jones and was expecting to move down to 400, and it didn't happen. So, you know, until the Dow hits 400, I think he is going to continue to be bearish. I mean, he's rightfully bearish in this point, in that we are in a corrective move, overall corrective trend. When you look at the larger degree, if you're talking about a weekly chart or a monthly chart, this is not the start of a new sustainable rally. However, you can't, you know, every single top say that that's the top and that we're heading, you know, to Dow Jones Industrial 400 or S&P 500 or whatever his targets are. You know, you have to wait for support to break down. You have to look for the patterns that confirm it. You know, it's just sensible trading and being willing to admit when you're wrong. That's a good reference. The moment of event horizon, when you are sucked into the hole and can't get out, has a 1618 number related to it. A book, Black Holes and the Time Warps, explained it. That's really interesting. Again, when I go over some of the other things about Fibonacci numbers, I think is one of the subjects I'm going to be focusing on for the theory part. You'll notice that Fibonacci and the ratio phi, the golden ratio, shows up in nature everywhere, absolutely everywhere. It is, I think, you know, basically the building blocks of our entire universe is based around the Fibonacci and the golden ratio. So it makes sense that price patterns in our stock markets and our financial markets, you know, follow this same mathematics. Any other questions? No? No more questions? All right, well, I hope everybody has a good night, and I hope that at least portions of this webinar were educational and helped you understand Elliott wave theory a little better. Again, if you have any questions that you think of in the future, feel free to ask them on the trading room, or you can private message me. Again, I encourage you to start counting charts on your own. You can send them to me, and I'll look over them if you don't want to initially post them in the trading room. But really, this is, I think one of the best trading methodologies and, what you should be using if you want to become a successful trader. All right. Have a good night, everyone. I will speak to you guys later.